All right, here we go. So, how to pay for housing is one of the most consequential decisions that most households make in their lifetimes. If you look at how much people spend on housing, if you look in the consumer price index, it's more than 28% of what Statistics Canada estimates the typical Canadian spends on stuff. So it's important. It's a big expense. And there's this common perception that renting is throwing money away and that owning a home is a universally good decision. But I think that mischaracterizes the costs of owning a home. And people will be familiar. I've talked about this before. Homeownership does offer a leveraged real estate asset and a lot of forced savings through mortgage principal repayments, which are good, probably. But but it also requires you to hold this one real estate asset, which is maybe not so good. I think ultimately the things that end up mattering are how much you're paying for housing costs, which could be different for renting and owning, and how the asset that you end up owning, which in the case of an owner is a house and in the case of a renter is something else, ends up performing over the holding period. Now, obviously, homeowners are purchasing this asset that pays, maybe this isn't obvious actually. Homeowners purchase an asset that pays sort of like an implicit dividend that's equal to the cost of housing. And then renters are just paying that cost out of their income or their cash flow. Both homeowners and renters are paying housing costs, though. The housing costs don't go away. And unlike rent, the costs of living in an owned home are kind of hard to observe and definitely hard to account for. Like people don't really keep track of them. Owners have property taxes, maintenance and depreciation costs, and the opportunity cost of having capital in a home rather than invested in some other asset. Renting gives you the advantage of separating your housing costs from investment. So you can invest in index funds or something else. And so I think that those, I kind of already mentioned this, but the two variables that are really going to matter in the long run for realized outcomes, like who ends up better off, are their housing costs and their investment returns. And so that's why it was interesting to look at with kind of real data in Canada, who ended up better off. And so I'm not going to get to the analysis yet. I got a little bit more in the setup. Any comments from you guys so far?
No, I'm just excited for the punchlines.
Yeah, I think one of the big variables here is, if renting is less expensive month to month, the assumption is that people will save and invest the difference. And of course, we know that that's not always the case. And so I think if you're going to be a renter with that logic, like that this is a better financial decision, you need to be careful that you follow through on the savings and investing part.
100%. So I have that in my sensitivity analysis. I have savings efficiency. So I looked at the base case is 100%, which I agree is a big assumption at least. And there's a material effect if I drop it down. I think it went 90% and 80% efficiency, which is just like how much of the cost difference does the renter save? And it makes a big difference. But we'll get there when we get to the sensitivity. One other thing that I think is really important that I don't know if people really understand is that there should be theoretically an equilibrium in the housing market where the total costs of renting and owning are basically the same. Like that kind of has to be true on some level if you believe markets are even a little bit efficient. So there's this highly cited 2005 paper where they describe how to compare the total cost of owning, they call it the user cost of housing, to the cost of renting. So those two things, the user cost of housing, like how much do you pay to live in an owned home, and rent should be the same in equilibrium. So they define the user cost as the opportunity cost of capital invested in the home, property taxes, maintenance costs, and a risk premium to compensate homeowners for the higher risk of owning versus renting because you've got this concentrated risky real estate asset. And then they also include the expected capital return on the real estate asset as a negative cost. And they subtract tax deductibility of mortgage interest and property taxes, which is something that's relevant in the United States but not in Canada. So in equilibrium, we would expect the total cost of renting and owning to be roughly the same. But in real markets, Like, even if you do believe markets are pretty efficient, it doesn't mean that they're going to be perfectly efficient all the time. So I think it is possible and reasonable to expect that either renting or owning may be financially attractive, both ex ante, before the fact. Like, you could look at rent and say, yes, it's cheap right now, and ex post, after the fact, where you could look back and say, well, yeah, renting was a better decision or buying was a better decision. There's one really interesting paper, a 2012 paper by Baraka and Johnson, and they argue that emotional reasons to own a home, like the common perception that renting is throwing money away, may cause home prices to rise above their fundamental values. So that equilibrium may be shifted by the fact that people have non-financial motivations to own a home. And if that's true, it would make renting relatively economically attractive.
So the market can be irrational and emotional.
Yeah. I mean, I think it's a pretty interesting argument because it is such a commonly held perception that you've got to get out of renting as soon as possible because it's such a bad financial decision.
Did you look at this in other countries? Like, this is such a phenomenon in Canada, right? Where, and like if you go to Europe, I'm just using Europe as an example because I was there recently, but and of course, it's not like I'm interviewing locals about their thoughts on housing and stuff, right? It's just, I just don't get the same vibe that everybody is interested in owning property. You know what I mean? Like, I feel like there's been many, many generations of people that have just been happily renting, or like New York City, for example. It's not like the definition of success isn't whether you own the apartment you live in. It's whether you have a nice apartment, and whether you rent or own it doesn't really matter. And I just wonder, totally anecdotally, if in Canada, because I think we're only one maybe generation removed from the American dream of everyone having a backyard and a picket fence and a one income family and a pension and everything else, where that's been like ingrained in us growing up, is like you're not successful unless you own a property. And I just wonder if like in like 3 or 4 generations that whole mentality just disappears. So if we looked at countries where they're maybe ahead of us from that standpoint, if the emotional aspect of this is the same.
Yeah, I think it is probably different, and that shows up in home ownership rates. Like, other countries have much lower. I think Germany, for example, has much lower home ownership rates than Canada. And I don't think people are less happy or wealthy necessarily because of that.
Yeah. Interesting.
Yeah. Any comments, Dan, before we keep going?
Yeah, it's interesting, right? Because I think everybody knows this idea of renting is throwing money away. We've all heard it a million times especially from the generation above us. But I had never seen it expressed as a kind of self-fulfilling prophecy before, right? That in fact, if everybody believes that renting is throwing money away, it becomes that, right? Like it's really I had never thought of it like that, but it does make sense that it would actually influence the decision.
Yeah. Yeah. Now there are different risks. I think this is an interesting thing too, is that renting and owning, neither one is better than the other. Like, even if we can say at a point in time, hey, renting is relatively cheap right now, that's fine. That doesn't make it objectively better than owning, because renting and owning are exposed to materially different risks. Renting is risky because rents can increase a lot over short periods of time. And we've seen that in Canada since 2015 in the data that I have. There's really this sort of step function change in the rate of change of rents, where rents had grown a little bit faster than inflation from 2004 to 2014. And then from 2015 on, around the same time housing prices increased, rents just the rate of change of rents just increased a ton. They started going up a lot, which is interesting. And it's interesting how it coincides with house prices too, because it's like, were we in a housing bubble, or did housing costs just increase? Maybe housing just got more expensive. Now, owning a home offers a hedge against rising rents. And again, to the point I just made, over a period where rents rise a lot, if it's fundamentally because housing has gotten more expensive, owning a home offers a hedge against that. Rents go up, house prices go up. So the cost of housing increased, but you had a hedge against that because you owned a home. Can I
just ask, this is maybe not the best time to ask this, Ben, but I get this question a lot from clients who are renters. Should they over allocate to REITs, real estate income trusts, in their portfolio if they are renters, to offset, like to hedge if they're not going to own, or if they want to get into the market 10 years from now, or they won't be able to afford to get into the housing market for say 10 years, should they over allocate from market weights to REITs? Because as you just pointed out, owning real estate is a hedge against rental increases.
Well, owning a property is a hedge against the cost of living in that specific property. I don't know if owning REITs is a hedge against the housing market more generally. Maybe a little bit, but if you buy like a Canadian REIT, I don't know if that's necessarily going to hedge the cost of living in Squamish, or in any other specific place. So I don't know. I don't know if I love that. One of the other things that we'll talk about later is that individual homes have a ton of idiosyncratic volatility, like individual stocks. So again, there's a lot of house-specific risk that goes into how each property is priced. I don't know if REITs really solve that. The hedge is really like there's this one paper that talks about how every home is kind of like a perpetual bond indexed to that specific home. So it's like buying 30-year tips or real return bonds gives you a pretty good inflation hedge over that specific time period. It's the same thing. If you buy a house, it's kind of like buying a long-term bond that's indexed to the cost of living in that specific home. But that doesn't necessarily hedge you against the cost of living in some other home in a different part of the country.
Right. So I guess the wider geographically you look, the less of a hedge it becomes. Like even that neighborhood, okay, it's probably not a perfect hedge, but it's still probably a pretty good hedge for that neighborhood. But like that township, that province, then you go across the country and before you know it, it breaks down probably.
Yeah, I think that's right. And it does depend on the correlation in housing markets. So if, Toronto and Vancouver, for example, even though they're geographically far, if they're for whatever reason highly correlated, then Toronto could be a hedge for Vancouver. But there are also lots of reasons their prices could diverge. So there's this pretty famous 2005 paper by Sinai and Souleles where they showed that the risk of owning declines with a household's expected time horizon. So if you're going to live there for a very long time, owning is less risky, and with a correlation of housing costs in future locations, which is kind of what we were just talking about. And then rent, in their analysis, gets increasingly risky at longer horizons because you're just exposed to inflation risk for that period of time. Barras and Bertermier, and we had Sebastian Bertermier on the podcast, and he talked about this paper. They're the ones that describe homes as perpetual bonds indexed to that specific home. And so in that model of owned housing, owning a house is a risk-free asset for the homeowner. It's a liability matched asset against a really important liability for households. Now, the other side of that is just like a long-term bond. Like if you buy a 30-year real return bond, yes, it'll hedge you against inflation for 30 years, but in the intermediate term, and Dan, you had a post about this years ago talking about why you don't use real return bonds, and I thought was super insightful. But it's like if you have a 30-year liability, a real return bond hedges you against that liability, or hedges inflation over that period. But in the interim, like 2 years in, it can be really volatile. So it's not.
We saw that pretty dramatically
right.
over the last couple of years with inflation spiking, and real return bonds were not behaving the way I think people expected them to behave.
Yeah, exactly. It's the same with houses. Like, sure, it's a hedge in the long run, but it's still a really risky asset in the short run. And that doesn't show up in real estate indexes. That's a really important point. People will look at a real estate index and say, well, real estate's less volatile than stocks. There's a bunch of papers on this, though, that look at the idiosyncratic volatility of individual homes. And they come to different results, but they're all around sort of 10% higher than index volatility. So if you look at a standard deviation of a real estate index and it's whatever, say it's 5%, you should expect individual homes to be an additional 10% more volatile.
It's funny. I had this conversation with a client just yesterday, saying the reason your house isn't volatile is because somebody's not knocking on your door every 2 minutes offering you a new price for it, right? Like that with the market, you just see your assessment at the end of the year. In BC, you get an annual assessment on the property value, and you're like, okay, so it's just fewer data points essentially that gives you the feeling of it being less volatile, which isn't exactly what you're saying with the index. But I guess the index is just more diversified than an individual house, so that's why.
Individual stock volatility is higher than stock index volatility. Exactly. It's the same. It's the idiosyncratic volatility that goes away in the more diversified representation. Yeah. Okay, so there's these conflicting things, right? Like house prices are super volatile, but they're also hedges. So it's kind of hard to say whether buying a home is like objectively a good thing. And then there's also the piece about psychological motivations, maybe driving prices up beyond their fundamental values, whatever that means, and also hedging demands. If people have really high hedging demands, someone who doesn't need to hedge the cost of living in a specific home might be overpaying for housing if they don't care about the hedge aspect. Whereas someone who really wants the hedge, hey, that's great. So one way to kind of test how is housing performed as an asset is looking in the historical data, which is what I kind of got excited about doing. Although I'm not going to talk about my findings quite yet. And you can't just look at price returns of real estate in isolation. That's one of the other important things. Like people look at Canadian real estate. Me too. My prior going into doing this analysis was that real estate looked better over this period because price returns have been really high. But you also have to look at rents. It's what I said earlier. Like you have to look at how much did you pay for housing and what were your investment returns in the asset that you invested in, whether that's a house or for an owner or something else for a renter. So an analytical model that includes prices, cost of owning, cost of renting, and returns on some other asset is kind of what we need to understand the trade-offs of buying compared to renting empirically, like over a specific time period. So there's the one paper that I mentioned earlier, Baraka and Johnson, 2012. They simulate the rent versus buy decision at different times and locations in U.S. historical data. And they're looking at 1978 to 2009. And they look at the U.S. as a whole, 23 major metropolitan areas and 4 major regions of the U.S. And they find that renting beats owning most of the time in their sample. And they're the ones that said that the psychological reasons to own a home may make renting economically attractive. And so their analysis is kind of supporting that. And there's another paper, Cox and Followwill, 2018. They also find over multiple holding periods in the U.S. From 1984 to 2013. They're looking at 6 metropolitan areas. They find that renting has often been attractive relative to renting. I think I wrote that backwards in my notes, but just in case you guys are confused. But the paper actually finds that renting is usually more attractive than owning in their sample. They do find that at longer holding periods, they look at a bunch of different holding periods. At longer holding periods, owning tends to look better because transaction costs are so high. And they also find that for taxable investors, ownership becomes increasingly attractive, which I think we'll touch on that later too. Then there's another paper that it's from a prof at UBC and some co-authors, Somerville, 2007 paper, unpublished, but still really interesting. So they look at 9 metropolitan areas in Canada, 1979 to 2006, and they find that renters could have matched owner wealth in 7 of the 9 areas. But they do talk about how, and you touched on this earlier, Dan, they talk about how their finding would have required extreme discipline, low investment fees, and high investment returns, because I think they looked at both GICs and stocks as the alternative investments, and GICs didn't look so great.
Do you know which two of the 9 were the cities they couldn't match wealth in?
I don't remember, no.
I would assume it's Vancouver and Toronto, but who knows?
In my analysis, that is true. I don't know about theirs.
Yeah.
Because it's a different period, right? I don't know.
Yeah, they
I don't
go
know the details
1979, right? That's pretty far back.
Yeah. So, and then they do make a comment at the end of the paper where they say that the relative simplicity of building wealth through homeownership may be its greatest benefit. Because like you just buy a house and that's it. Whereas the renter has to worry about investing, saving the right amount, keeping their fees low, not making mistakes. And I think that's a pretty strong argument for homeownership. So the analysis that we've done here starts roughly where that sample ends. So I think they went to, what did I say? 2006. Yeah. So we started in 2005. And I think this is an interesting period because Canadian real estate has been like this global spectacle. Like everybody kind of knows that Canadian real estate's been insane over that period, roughly, maybe more so in the last 10 years, but still. So and like I said earlier, my prior going into this was that owning would look better all over the place. But it doesn't end up being true. So I built this model of a hypothetical renter and owner making the housing decision in January 2005. So they could have chosen they have some cash for a down payment. They could have chosen to rent and invest, or they could have chosen to own a home. Okay, before I jump into the model, any comments from you guys?
Nope.
No, I think you've covered everything.
Okay. So we had to get data, obviously. This is the big thing. CMHC does publish rental market survey data. So they're like literally calling people, landlords and residents, and asking them how much do you rent your place out for, or how much you paying in rent. And they do this for both primary market and secondary market rentals. And I'll talk about what that means in a second. We use the composite rents, which represent for apartments, which represent the weighted average of all unit types. So that's like bachelor, 1 bedroom, 2 bedroom, 3 bedroom plus, covered by the survey. And the rental survey is updated as of October each year. So we use the October of the previous year as the starting rental amount for the following calendar year. So our sample starts in January 2005. So we use October 2004 rent as the starting rent. So these rents represent rents in both new and existing structures, and they're the weighted average of both vacant and occupied units. That is a really important point. I was talking to somebody in Vancouver about this recently actually, where they've been renting for a very long time, and their rent is much lower than market rent because of rent controls. Vacant units, like if you call a landlord and ask how much is your vacant unit listed for, they'll tell you information about market rents, like the price of renting a new place today. But occupied units that people are currently living in many cases, and the data show this, in many cases they'll lag market rents because of rent controls or maybe some other agreement with landlords if it's in a place without rent controls. Like I think in Ontario, buildings after 2018, you don't have rent controls anymore, which has caused problems for a lot of people. And residential leases are typically a year. Sometimes people can extend them. So rents will for a given renter, tend to stay still for at least a little bit.
But they can't just, the rental caps apply after at least in BC, like even though the rental lease is a year, after that you're on month to month, but I don't believe they can just increase the rent to market rates at that point, right? Like they're still subject to the caps. Yeah.
Yeah, you're right. Okay, so primary market rental data cover purpose-built rentals with 3 or more units. So think like an apartment building that has been built to be rented out. And then secondary market data cover units excluded from the primary rental market, which includes things like rented condominiums. So this is someone who goes and buys a condo and then rents it out. That's called a secondary market rental. But then like, a REIT or something that goes and builds an apartment building and rents all the units out, that's a primary market rental. The secondary rental market data are a little bit more sparse. They start in 2007, and sometimes they're a little messier, like just fewer data points and things like that. So CMHC comments on the quality of each data point. And the secondary market rents were more often of lower quality than primary markets. But they're also generally higher than primary market rents, which is why I wanted to use them. At first I was looking at just primary market. But then I was like, I wonder how different the secondary market rents are. Turns out they're quite a bit different. So I was like, okay, well, I've got to include that information too. And then I weighted it by the number of units. So I have data on how many primary rental market units are available and an estimate of how many secondary market units are being rented out. So I did a weighted average of the rents based on those two points. Tenants insurance and home insurance, I found estimates of getting those types of insurance in each place today and deflated them back in time based on Statistics Canada, like CPI measure for those costs. The renter's portfolio, so the renter, the way the model works is that the renter saves the difference between their housing costs and the owner's housing costs. Invest it, they stick it into a portfolio. So in the initial year, there's the down payment, the renter's investing that. And then every subsequent month, if the renter's paying less in housing cost than the owner, the cost difference is being invested in a portfolio, which means a lower level of rent relative to the cost of housing. It results in the renter saving relatively more. An important and potentially contentious assumption that I make is that the investment returns are not taxed. I'm looking at a non-taxable account, which means they're either using an FHSA, an RSP, a TFSA, or some combination. The RSP was available through the full sample. TFSA appears in 2009, FHSA more recently in 2023. But based on the amounts being saved, like I looked at, if you were buying a house in 2005, would investing the down payment in an RSP be sensible? Like, do the amounts line up? So the highest down payment was in Vancouver, $43,220, which, based on the median income level at the time, would have been roughly 4 years of accumulated RSP room. So I don't think it's crazy. And then the future savings after that would be much lower than the annual accumulated RSP room. So I think it's reasonable enough. And the average person's not maxing out their registered accounts. So if we did include taxes on investments, and I've done this in other, like in forward-looking analysis and in the projection type analysis instead of the historical, adding in taxes makes owning look better, and increasingly so at higher personal tax rates, because your after-tax investment return becomes lower and lower. So that kind of implies that in cases where registered accounts have been maximized, owning a home is relatively attractive, and then increasingly so for high income earners. The portfolio I use is 30% MSCI Canada IMI gross dividend, and 70% MSCI all country world IMI net div. Net div just means there's an estimate in there for foreign withholding taxes taken off. And then I net out a 0.25% fund fee, rebalance monthly. Now that asset allocation was not available for 0.25% in 2005. Later in the sample, it is. Like, you could buy VEQT today for a little bit less than 0.25%. I do think that over the full sample, 0.25% is reasonable enough. It would have been more of a hassle to try and recreate an actual ETF portfolio, for example, or to use different fees over time. And I did, there's one other thing I thought about for this, just as a reasonableness test. But the gross of fees return on the portfolio over the full sample period is nominal 8.19% annualized. Now, so this is the other thing I thought about. XIC, which is the iShares Core S&P TSX Capped Composite ETF, was available at the beginning of the sample. And foreign ownership limits in the RSP account were only eliminated in 2005. So, like, it would have been reasonable for someone to be all in on Canada back then. So a lot of home country bias. And it was really in 2013 that a full suite of proper low-cost ETFs, like what people are used to today, became available to build out our target asset allocation. So I can imagine a scenario where someone invested in XIC until 2013 and then added more diversification. And if they had done that, Canadian equities outperformed the global allocation until June 2015. So in that scenario, they would have been better off than the actual model. Anyway, that's just my mental justification for the 0.25% fee for the full sample. Any comments before I keep going here?
No, I think it's reasonable, right? Like,
I think so.
Like the number of people that actually had the exact experience you're trying to describe is probably 6, right? And so, like, you have to make some reasonable assumptions to find some kind of something to take away from this, right?
Yeah. Okay, so the home price data come from the MLS Home Price Index for the apartment benchmark. So the HPI, it's called the HPI, Home Price Index. So the HPI is a hybrid model that merges repeat sales and hedonic price approaches to creating a home index. You know what? I can probably skip over the details of how that works. But basically, it's like they control for, or they create a benchmark home based on what they think is a representative home in each area for a given period of time. And then the index is based on changes in how each of the individual features are valued over time. So it accounts for stuff like how many bedrooms you have and I don't know, how close you are to transit and stuff like that. And those are all incorporated based on other past sales of homes with shared characteristics. They calculate how a benchmark home changes in price over time. It does not account for the idiosyncratic volatility that we mentioned earlier because it's a more diversified representation. So that's just an important thing to think about. And I didn't try and model that, but I think it's just worth keeping in mind. For transaction costs, I had 2% for closing costs, which is based on a 2008 paper. and I had a 6% selling cost, which is based on one of the 2012 Baraka and Johnson paper. That's what they used. And I think that's pretty reasonable. If people had a lot of real estate transactions, like we model 1, they just buy the house. If they had 4, it would decrease the owner's wealth because of transaction costs.
And that's probably common, right? Like it's rare that somebody buys one house and never leaves.
Yeah, I've had trouble finding data on how frequently Canadians turn over their primary residences. In the US, one of these papers has data from, it's a bit dated now, but it's about 8 years, the typical holding period for a US owned home.
Yeah.
I'm not sure what it is in Canada. Now, the other thing that's important here is that while renters don't have transaction costs, they do have that risk of going from below market rents to market rents if they move.
Yeah. And I think it probably depends on the timing of the purchase, right? Like many people are saving and saving and saving and renting until they're 35, 37, 40 years old and then buying, right? So the turnover for somebody who does that, maybe they buy their family home at age 40, whereas somebody who gets into the market at 26 is probably buying a condo and then maybe a townhouse and then a family home. So it's going to be different depending on the timing of the purchase, like in the life cycle.
The other thing that I think is kind of interesting that I don't try to analyze and don't even have any comments in my notes on, but I'll mention it, is I think when people buy homes, they'll often buy for their future selves. Like they'll buy a bigger home than they need now to avoid having to move. Mm-hmm. But that really just increases your housing costs relative to if you'd rented something more reasonable for your current situation. But just anecdotally, I've talked to people who are like, yeah, I'm thinking about renting a 2-bedroom or buying a 4-bedroom house.
Yeah.
What?
Future-proof.
Yeah, future-proof, right. Okay, depreciation and maintenance cost. This one, man, is it's hard to pin down, and it's another contentious assumption. But I think it's really important. I mean, I know it is because it shows up in the analysis results. So the HPI index that we're looking at does not factor in the cost that the homeowner has incurred over time in terms of depreciation and maintenance. So we're looking at these historical index returns, but they're reflecting money that has been added to the asset over time by the people living in the homes. The depreciation that a specific homeowner might experience from year to year and how well or poorly a specific home has been maintained are both going to affect the home value at the time of sale. But again, the HPI won't necessarily capture that. So we need to make some adjustments to the home price index returns. Buildings are depreciating assets. Whenever I make content on this, people are like, you're crazy. Like buildings don't appreciate. No, buildings appreciate. Land appreciates. People look at real estate over time and see it goes up. That's land and money that people are adding to buildings. But the buildings themselves are depreciating over time. There's normal wear and tear, like stuff just getting used. It's consumed. Housing gets consumed. Like you need to replace your roof, for example. But then the other thing is obsolescence. Like my house is built out of ICF, insulated concrete forms. But the version of insulated concrete forms that was used to build this house in 2003 are now outdated. So it's therefore less valuable than a newer ICF home, just as an example. So maintenance spending over time reduces but doesn't eliminate depreciation. So what number do you use for this? There's a response to a 2006 paper. So it's like a critical response to a 2006 paper on this topic. The critical response suggests a 2 to 3% for maintenance and capital expenditure. There's a 2007 paper that looks empirically at U.S. housing, and they find that it depreciates roughly 2.5% per year gross of maintenance and 2% net. So people are adding back 0.5% in maintenance spending, but they're still depreciating at 2%. And then there's a big 2005 paper, the one that estimates user cost. They used the 2.5% figure to estimate that. There's another empirical paper that looks at multifamily investment properties, commercial and multifamily properties in the U.S., a 2016 paper, Bakari and Geltner. They find overall average depreciation of 1.5% per year. And their estimates range from 1.82% for properties with new buildings to 1.12 for properties with 50-year-old buildings. Now, those are net of maintenance. So like maintenance has been added back to that to reduce how much the buildings were depreciating, which means to find our maintenance and depreciation costs, we would have to add maintenance back. So they don't do that in this paper, but they do note that the NCREIF, which is the real estate index, records suggest that nearly 20% of property net operating income is typically reinvested in maintenance and upgrades. So all those figures come in.
This is of the building value of the home purchase value?
Well, so it's technically the building value, and that would be the ideal way to do this, especially in places like Vancouver and Toronto, where the land is a increasingly large portion of the value of a home. I don't make that adjustment because I don't have good data on relative land and building costs, and a lot of these papers don't. A lot of these papers say you just use 2.5% or whatever of the property value, acknowledging that there's a little bit of a bias in there.
Well, and I guess with things like townhouses or condos where they're like what you're buying, there's very little, if any, land value to what you're actually buying, right? And you're paying like strata fees, which essentially cover a lot of the maintenance and depreciation costs anyway. But I guess the percentage of like a strata cost would be probably in line with the total home purchase price, like 2.5% of the home purchase price. Whereas a single family residence, like you said in Vancouver, like my property, I think is maybe 25% of the value of it is the building itself and the rest is land. So you'd have to look really locally at the type of building, like the type of dwelling, and geographically at the differences.
Yeah. So we are looking at apartments here. And I agree that strata fees or condo fees would cover a lot of the costs that we're talking about. But you could also have stuff like, a building reserve declining relative to future maintenance costs over time, which will eventually show up as a special assessment.
Yep.
So these costs can show up a lot of different ways, or in resale value because you've got an older building relative to newer buildings that are going up. Statistics Canada uses 1.5% of the building value. They're explicit about that for depreciation for homeowners when they're calculating how much it costs to live in a home. And then they also have an estimate for maintenance. Combining those two together, it comes out to about 2.1% of the building value. So that's what Statistics Canada is using. But you look across all these studies and StatsCan, and it's like somewhere between 2 and 3% of the property value, maybe more technically the building value, is a reasonable assumption. So we use 2.5% in our model. And then we do some sensitivity around what if it was higher or lower. We use a 25-year mortgage, 20% down payment, 5-year fixed rate. And we get mortgage data from the Bank of Canada and Statistics Canada. We use advanced mortgage rates, which is like the rates on actual advanced mortgages. So like the mortgages have actually been issued by banks. What are the average rates on those? When the data are available, but they're not available for the full period. When they're not available, we use posted rates, which tend to be much higher, minus 1.95%, which is the average difference between posted and advanced rates over the full sample. And then property tax, actually note on that, we're still working on getting some property tax data because it's like literally calling municipalities and saying, hey, your website only has property tax records back to 2018. Can you send us back to 2004? So Hamza at PWL has been working on that. So I've got detailed data for a bunch of the areas that we're talking about, rougher data for some, but I don't think that the results are going to change much once we get them updated to the actual values. Like it's kind of close enough right now, but just not quite perfect, just as a note. Okay, so the main results. It's mixed, which is interesting because my prior going in is that owning would dominate. The ending wealth, renting beats owning in 7 of the 12 metropolitan areas. And I looked at Toronto, Montreal, Vancouver, Calgary, Edmonton, Ottawa, Winnipeg, Quebec City, Hamilton, Kitchener, Waterloo, Victoria, and Halifax. Owning wins in Toronto, Vancouver, Calgary, Edmonton, and Waterloo.
Even
and
Edmonton
comes out ahead.
That's interesting.
Edmonton was a really interesting one because the price returns in Edmonton over this period were not good, but rents were really high. So it really shows you've got to look at both of those factors to see who was better off. Rents were really high relative to the cost of owning. If I take the simple average of all of those areas, the ending net worth difference favors renting by about $15,000 at the end of the sample. So not huge, which is what you'd expect if there's an equilibrium of housing costs. But I do think it's interesting.
Winnipeg was the best place to be a renter, not an owner, over that period. Is that right? I'm just looking at the notes that you've posted here.
Yeah.
Okay. Just making sure I'm reading the data.
In terms of the wealth accumulation.
Okay. I point that out specifically because there's a guy I talk to almost daily on Twitter who's like a huge landlord in Winnipeg. And I hope he's listening. And he just loves Winnipeg real estate and just talks about how good he's done in Winnipeg real estate over the past like 20 years versus like global stock markets. And I've always been skeptical that that's necessarily true. And I think a lot of this just comes down to just anecdotes and he's not tracking the data correctly. And so I just wanted to very specifically call out that Winnipeg was actually the worst metropolitan area that you looked at for being an owner versus a renter over that time frame. So if you're listening, gotcha.
He still could have done fine though, right? If he's a leveraged landlord, if you look at the rental yields were still pretty high. The capital return was not the highest by any means, but it wasn't terrible.
Yeah.
I have about 2%, 1.85% real annualized over the period. And then rental yields were high enough that if you're a landlord and your costs aren't too high, it's probably not bad.
Yeah.
Okay, so yeah, it's really looking at those two factors, like high rents relative to the cost of owning and low realized real estate returns make owning look worse relative to renting. But in other cases, high rents and high realized real estate returns make renters disadvantaged relative to owners. Either one can sway the outcome. You don't have to have both. So the Edmonton example I thought was pretty interesting, where price returns were pretty low, but rents were relatively high. On average, 6.5% of the property value in rent was paid by Edmonton renters, which is, I think, the highest. Yeah, it's the highest of all the places that I looked at. So it like, keeping in mind that we're comparing the total cost of owning each one. So in the case of the Edmonton renter, they just didn't have much money to save. Like, they saved their down payment, but then their monthly savings was minimal. And then Ottawa was another interesting one where price returns were kind of high, 2.68% real, but rents were pretty moderate. So renters actually come out ahead there. The biggest advantage for owners was in Kitchener-Waterloo. They had really high price growth and kind of high rents. And then for renters, like you noted, Mark, was Winnipeg, which had lower price growth and kind of moderately high, but not too high rents. And the rental growth wasn't too crazy. I was surprised by Victoria. Price growth was super strong there, but rents were really low. But then Vancouver had even lower rents, but price returns were higher, which gave owners the advantage there. So it's hard to predict, like, this place did better. You have to know the relationship between the relative costs of renting and owning and the returns on the assets over the period.
And even within that period, there was, like you said, multiple sort of sub periods that would be really interesting to look at, right? Like in Vancouver, as you pointed out, I think from 2015 on, things just went absolutely banana. Like, I was looking at Vancouver rents like maybe 6 or 8 months ago, because I used to live in Vancouver and we moved to Squamish like 5 years ago. I was like, I wonder what rents are doing in Vancouver. And wow, like, it's unbelievably expensive to rent in Vancouver now.
Yeah, it is. But very expensive to buy a home in Vancouver too.
For sure, yeah.
But yeah, so there was somewhat of an inflection point around 2015 where rents and prices just kind of started to go up like crazy. I didn't look at the full comparison over that sub period. One thing that is worth mentioning, actually, I don't have my notes, but in Calgary and Edmonton, there's this big spike in prices early in the sample and then a big drop. And so if you bought at the beginning of the sample, you kind of were insulated from that. But if you bought at the peak, I think it was like 2007 or something, Calgary and Edmonton had this really big bump up in prices that then dropped down. If you bought then, the owners looked better in the full period, but if you bought then, renters would have come out way, way ahead. So there is I don't know what that is, idiosyncratic timing risk or something.
That's why I mentioned Edmonton being interesting, because I think prices there have barely, if only recently, eclipsed their previous peak, which I think, to your point, was like somewhere between 2007, 2009 or something like that.
Yeah, I do have that charted. They have come back, at least in nominal terms, from that previous peak.
Yeah,
maybe not in real terms though. So investment fees, super important. I had the 2.25% baseline assumption, but over the sample period, 2005 to 2024, people were paying way more than 0.25% in fees. Like, it was probably 2.5% on average. In 2022, it was 1.76% on average, largely driven by active mutual funds. If I bump the fee up to 1.76%, renting trails owning in 10 of the 12 areas. So it matters a lot. And realistically, I mean, it's an interesting point where, like, in reality, like, we're talking about this model, in reality, Canadians over this period were probably better off owning than renting, because they were getting hosed on investment fees.
Mm-hmm.
The savings efficiency thing
they weren't too. They were, good luck maintaining a 100% equity portfolio.
Yeah.
over that period with, you know, discipline.
Yeah, no, that's
That would
true
have been
too.
extremely difficult to do.
I agree. Honestly, doing this analysis, like it shows that renting comes out ahead in the way that the model is set up, but going through it has made me probably more likely to tell people that they should just own their home.
There's a lot of caveats to get renting
Yeah.
out ahead, and it's not that you're biased, right? It's just that a lot of these caveats, Dan, as you point out, like are difficult to actually achieve. Like the discipline that it requires to save every dollar between the ownership and rental costs, and sitting on your hands through events like 2008 and COVID and everything like not making those mistakes. Much harder to fire sell your home in 2009 than it would be to fire sell your portfolio, right?
That's actually a really interesting point, because I have made this argument with clients before, is that people will panic sell stocks. Nobody panic sells homes. In fact, they do the opposite.
Right.
If you own a home and housing prices plunge, I mean, almost everybody says it doesn't matter because it only makes a difference when I'm ready to sell, and I'm just
Yeah.
going to hold on to it. Well, it would be great if you applied that same discipline to stocks, but people don't, right?
Yeah.
So,
Yeah. So on the savings efficiency, 100% is the base assumption, where owning comes out ahead in 5 areas out of the 12. At 90% savings efficiency, that's saving 90% of the available cost difference in renting between renting and owning. It's 7 out of the 12 areas. So we bumped up from 5 owning being better to 7. And then if I drop that down to 80% savings efficiency, 10 out of 12 areas, you're better off owning than renting. So I mean, to your point, Dan, it really highlights the importance of discipline. If you're and 80%'s like that's a lot.
it is, yeah.
It's
And,
probably
you
more
know,
than most people are saving.
that's why that term forced savings is
Yeah.
used all the time, because it's very good description of what it's like to own a home, right? People
Yeah.
don't elect not to make mortgage payments, but they sure as heck elect not to, you know, save in a given month. And so,
Yeah.
Especially in an emergency too, right? Like the last thing you will stop paying is your mortgage, and the first thing you will stop paying is your savings plan.
Yep.
Right? They're on total
Totally.
opposite ends of that decision matrix.
The maintenance cost assumption, which I mentioned, is often contentious. So the base case again is 5 areas owning was better. At 2%, 7 out of 12 areas favor owning, and at 3%, which is still within the range of sort of the academic recommendations for what to use here, only 3 areas favor owning. So that assumption about how much you're going to spend to maintain your home, and how much will it depreciate over time is super important. At 2.2%, I just looked at kind of where's the break even in terms of the number of areas. At 2.2%, 6 out of the 12 areas still favor owners.
that's an interesting number too, though, right? Because it's pegged to the value of the home, you said, whereas, you know, if you own literally the same structure in a expensive market versus an inexpensive market, presumably the maintenance costs are going to be pretty similar in dollar terms, but the percentages are going to be thrown way off based on
Yeah.
that, right? Like
Yeah,
home
totally.
maintenance isn't more expensive in Vancouver than it is in Winnipeg, I don't think, but the same house would have a very different price in those two markets.
Yeah, that's definitely true.
We talked about that, Ben, I think a few weeks back when you were first starting to look at this, and I was trying to wrap my head around the maintenance cost issue. And Dan, that's the exact thing that I was stuck on, is if I took my house and lifted it up and put it in a rural place in Manitoba, the cost would be 30% of what it is here in Squamish. So as a percentage, it wouldn't make sense, which is why I think, and again, I know the data is hard to find, but the maintenance cost as a percentage of the building value probably makes more sense, right? Because if I transpose my house into rural Manitoba, the building cost presumably doesn't change that much. It's the land value cost that's going to be reduced significantly. But as a percentage and as a dollar value, the maintenance versus the building cost likely doesn't change in those two locations.
Yeah, but the data is impossible to get on
Yeah.
that. It's like, right.
Yeah.
Yeah, not so easy to get the data. And keep in mind, it's maintenance and depreciation, not just the explicit maintenance costs. Like how much less does a building appreciate in one area versus another based on the building being slightly owned or less well maintained. And that may make more sense, where an older place in Vancouver would sell for proportionally less. Does that make sense? I don't know.
I don't know. There's a place in downtown Vancouver. There's like one single family house like in downtown Vancouver, and they just refuse to sell. And when I drive by it sometimes, I'm like, that thing must be worth $100 million now because it's the only single family house. Like there's towers everywhere, and it's this
That's
one
too
little
funny.
yellow house, I think. And they're just holding out, right? I don't know why. Maybe it's just principle at this point, but I wonder what it's worth, or what
Yeah.
I wonder what developers have offered them.
So that's a good example where the building's probably worth like nothing, basically.
The
relative to
location
land.
is everything. Yeah.
This is a quick addendum to the discussion on maintenance costs. I'm recording this the day after we recorded the rest of the episode, but I really wanted to get this in because I think it's important. Mark and Dan made the valid point that maintenance costs in, for example, Vancouver are not going to be twice as high or whatever the number is as maintenance costs in, say, Winnipeg or Edmonton, just because prices in Vancouver are higher. And so we had talked about different ways to account for that, like looking maybe at the building value, looking at maintenance costs as a proportion of the building value. In any case, I wanted to figure out a better way to model it. So I split out maintenance and depreciation. I'm now applying depreciation to the eventual sale value of the building. And then I've got maintenance as a separate cost. Figuring out what to use for a maintenance cost is tricky, but I realized that a pretty good source is just looking at condo fees, because people pay, I mean, they're called maintenance fees for a reason, because they're part of the cost, a large part of the cost of maintaining a condo building. So what I did is, for each city that we're looking at historical data for, I went and pulled 12 current real estate listings. There's nothing magic about 12. That's the number of listings that Realtor.ca shows on a page. At least that's the standard number of listings. So I opened up Realtor.ca, went to each city, pulled the first 12 listings that I saw. I took out duplicates and stuff like that. And then I recorded the price and the condo fees, the monthly condo fees for all 12 of them. And then I took the average. I made sure that the average listing price was close to the benchmark price for that city, the final month benchmark price for that city in the model. And then I used the average of the maintenance fees as the cost of maintenance, plus 10%. I added 10% because condo fees are not 100% of maintenance costs. So I've got 110% of that average condo maintenance fee figure as the final month maintenance cost in the model. And then I reduce that through time. I deflate it through time using the inflation rate of the home maintenance and repairs index in the CPI for each province. It's reported at the provincial level, not the municipal level by Statistics Canada. So that's what I used. So the effect is, for lower price cities like for Edmonton and for Winnipeg, maintenance costs as a percentage of property prices went up a lot. And then for higher price cities like for Vancouver and Victoria, proportionally, maintenance costs went down. In dollar terms, they're now more consistent across all the different cities. In Toronto, I think maintenance costs actually went up relative to the proportional model, because I guess, and I hope this isn't just sample bias from the random 12 that I picked, but it seems like condo fees in Toronto are relatively high. And another interesting one was Montreal, where condo fees are actually pretty low. So I think maintenance costs there went down. Overall, directionally, the results didn't change much. Victoria is the only one that flipped from being advantageous for renters to being advantageous for owners over the sample period. And it wasn't by much. It wasn't by much when it was advantageous for renters, and it's not advantageous for owners by much now. The average ending net worth difference went from favoring renters by $15,000 to favoring renters by $22,000. So, I mean, pretty immaterial overall. But I think that commentary from Dan and Mark was valid to the point that it was eating me up inside, and I had to improve the model, which I've done. And then I felt guilty leaving listeners hanging for a couple of weeks. So I'm hoping that adding this into the episode makes the overall discussion that much more useful. All right, that's it. Yeah. I also looked at mortgage down payments and amortization. So 25 years is kind of the typical amortization used by Canadians. At a 15-year amortization, so that means you've got higher payments and less debt. Owning a home only beats renting in 3 of the areas, and renter wealth exceeds owner wealth by $78,000 on average. So that assumption makes a big difference. And a 35-year amortization, which would require a 20% down payment, which is what we're modeling anyway. Owning beats renting in 6 areas, and owner wealth exceeds renter wealth by just over $15,000
So
at the
that's
end of the
an
sample.
interesting finding. You're saying it's not really an argument for paying off your mortgage more quickly, is it?
No, it's not. Yeah, it's the opposite for sure.
Yeah. So, which, most people would think common sense, pay off your mortgage as soon as you can afford to do it. But the leverage is clearly working to your advantage here.
Yep. And a lot of people point this out when I talk about renting versus owning a home. People say, well, you can't get a mortgage as a renter. Like, mortgages are amazing. And they don't necessarily make owning better, but you can see from that short example there that the mortgage definitely has an effect. Down payments matter too. So 50% down payment, renters come out ahead in 9 out of 12 areas, and renter wealth exceeds owner by $59,000. And then at a 5% down payment, the kind of baseline result holds, with renters coming out ahead in 7 areas. But the average wealth advantage drops to just under $12,000, which is lower than the base case. So again, same thing, where leverage is good for homeowners, at least over this period. Okay, so in line with at least those 2 past studies that we mentioned, we found in our analysis that renting and owning were both perfectly reasonable approaches for paying for housing in Canada over the period 2005 to 2024. There was no clear dominant approach, even with house price appreciation being kind of crazy and rent inflation being kind of crazy in Canada, especially in the second half of the period. I think it suggests that renting is a reasonable option to pay for housing. But as we already talked about, I think it also highlights the importance of discipline, which a lot of people don't have, and low investment fees, which a lot of people don't pay, which kind of makes owning look pretty good. It's like what that 2007 UBC paper said, that renting looks pretty good in our model, but it takes a lot of stuff to happen or to go. People have to do the right things at the right times, not panic sell, pay low fees, be disciplined with their saving. And if any one of those things falls apart, it makes a big difference to the outcome. So like I mentioned earlier, I think going through this analysis even though it showed that renting comes out ahead in the model, I think it actually shows that in a lot of ways, owning is a pretty sensible decision for a lot of people. Renting is a viable option, though. If someone wants to rent and can be disciplined and will have low fees and so on and so forth, I think that's great. This shows that you can be successful as a renter. But for the average person, I don't know. Owning's probably pretty compelling.
I think that's a great takeaway from it, which is not that, the model shows that renting is preferable. It's that the model clearly demonstrates that the idea that renting is throwing money away is just simply not true, right, unless you assume you're inclined to throw your money away. Right. Right? Yeah. In other words, yes, lots of us struggle with discipline and pay high investment fees and etc. But for those of us who don't, renting is a perfectly viable option. And to suggest that, you're going to end up further behind if you choose that method is just simply not true, unless a whole bunch of other things are also biasing that.
Mm-hmm.
Yeah.
Yeah, it's less of a mathematical decision than a behavioral one, it sounds like, right? So you shouldn't approach necessarily this problem as a math problem.
That's an interesting question too, and I have no idea if there's any data on this, Ben, but do we know whether as a group renters are happier than homeowners or the reverse? Because I can certainly see it in both ways. And I've been both. There's something about renting that is extremely liberating, that you never have to worry about, the leaky basement and, the other things that keep homeowners awake at night. But there's also great pride of ownership, satisfaction, so it can work in both ways, but I don't know in aggregate whether we know which group is happier.
Yeah, there is a bunch of research on that actually. I just wrote an article on this for the Globe and Mail. There's even one paper that looks specifically at Canadian data. It's a 2021 paper from a guy at, I think, Thompson Rivers University. Overall, I think that the evidence kind of shows that owners are not happier than renters. They're not less happy, but it's pretty neutral. The Canadian paper specifically showed that owners at lower income levels are less happy. Mortgage debt makes people less happy. So even in some samples where homeownership makes people more satisfied with their housing, the fact that they have mortgage debt kind of neutralizes the effect on their overall life satisfaction. What else was there? One study showed that female homeowners specifically, which is the sample they were looking at, are less happy, and it's largely due to time use, where they spend less time on active leisure activities and more time on housework, and that negatively impacts their overall happiness. There's a bunch of papers on this, though. It's a super interesting topic because that's one of the criticisms that I get when I talk about, and keeping in mind that we're just saying what we just said, that renting's not stupid. But I'll say that, and people are like, yeah, but renting's miserable. Like, renters are so unhappy, and they're always worried about their landlord coming into the bathroom when they're showering. I'm like, what? No, I've rented. It's not that bad. But yeah, anyway,
Great.
A bunch of research on this, and it's kind of, I would say, fairly neutral in terms of happiness, with maybe a slight tilt toward owners being a little bit less happy because of their time use constraints.
And Dan, just anecdotally, when I was a renter, I felt the same sort of liberation. And I think it's easy to say that in hindsight now as a homeowner. It's not that obvious when you're a renter. I think it's a grass is always greener type of situation where you want to be an owner, and then you become an owner and you're like, man, renting was really easy and I could pick up and move. And there's a flip side to that, right? But there is a lot of psychological benefits or stress related benefits to renting in my anecdotal experience.
Yeah, and it really comes down to, I think, if you're going to talk about, happiness that comes from home ownership, the presumption is you bought a home that you like and that you can comfortably afford. Because if you bought too much house, which was incredibly common over the last decade or so, that's not a recipe for happiness. That is a recipe for stress, for sure. So, I think most people who can buy a house and comfortably make that mortgage payment, it's great. But if you're stretched every single month and you're constantly worried if interest rates go up, I'm going to be in big trouble, that is not a recipe for pride of ownership.
Oh.
And some of this is just so outside your control too, right? Like, we love our neighborhood, and a lot of it's because we have 2 young kids. We have a single family house in kind of a cul-de-sac type of area, and there's like 20 other kids within 100 houses. And so on any given day, especially in the summer, my son can just open the door, go outside, and there's 10 kids to play with. But if that wasn't, and we didn't necessarily know that before we moved here, right? You can't knock on people's door and say, what's your family like? We want to move into the neighborhood. But if a bunch of those neighbors moved, or if that wasn't the case, I bet our happiness with this location would be less. And so a lot of that just comes down to luck, right? Or they were going to build a development right through the forest next to our house, which we didn't know about until about 2 years after we moved into this house. So they were going to punch like a gas line through, not quite our backyard, but like 100 meters from our backyard in the forest. And so there was uproar about it, and it ended up falling through. But had they gone through with that, that's just bad luck that would have led to a reduction in happiness for us, for sure.
Interesting. I've always surveyed the neighbors, whether renting or buying. I've gone around and knocked on the doors and been like, hey,
Yeah, you would.
Hey, moving in
Ben
here.
Felix, that's what you do.
what do you think of the neighborhood? I always got good information from doing that. We actually had something similar when we bought our house. There's a massive forest kind of in our backyard called the 100-acre wood. It's like literally 100 acres of just forest with a bunch of beautiful hiking trails. And developers were about to buy it. And so a bunch of people in the area raised money, and through a charitable organization, which we ended up donating a bunch to. And I just kind of thought, you know what, this is going to be part of the cost of buying our house because we want to maintain the forest. And so the community group ended up buying the forest. So now it's conservation land. Very
Very cool.
good. But like your point, it could have worked out differently where that became a massive housing development, which is like, we moved out here to not be near that.
Yeah. And it can affect the prices too, right? Like, values of homes here might have gone down as a result because they were less desirable if they'd done that. I don't know.
Yeah. I do want to move on to Dan's topic, but I just one other thing, Mark, you mentioned how renters imagine they'll be happier as homeowners, and then they look back and kind of think, wow, renting was pretty good. There is one paper that I looked at for that happiness thing on is using German data, and it found that people significantly, they show that homeownership does make people more satisfied with their lives a little bit, but they dramatically overestimate how much happier they're going to be. So it does make them a bit happier, but not nearly as happy as they expected when they made the decision to buy a home.
Like most things that we think will make
I was
us
gonna
happy.
say.
Yeah. Yeah. So it does link it to extrinsic motivations. So people in the study who are more extrinsically motivated had the worst bias in terms of overestimating how happy they would be when they bought a home anyway.